I'm not gonna lie, I'm still bearish here in the short term for the broad market. All of the evidence that I can see still supports this thesis. However, in today's episode, we'll play devil's advocate and talk about exactly what it will take for me to change my tone and turn back into the permabull of YouTube. Welcome to the Trade Brigade Weekend Show. My name is Matt, and if you're new here, hit the thumbs up button and subscribe so you don't miss future episodes. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's episode. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. A SPY monthly time frame chart so I can be crystal clear about the time frames where I'm bearish and the time frames where I'm actually still bullish. On the monthly chart, the trend is still in the upward direction and we're pulling back from the highest high in the trend sequence. If we take a look at where higher lows would be acceptable, anything over the previous all-time high prior to the drawdown in 2022 over here would make sense for that higher low. We have lows, higher lows, and this structurally makes a lot of sense for a possible higher low. So the trend here is up. Now, I want to remind us of what took place in the great financial crisis and the dot-com bubble bursting. Here, the monthly trend was already down with lower highs and lower lows before the most painful moment. And the same thing was true if we look back to 2001. We had highs, monthly lower highs, lows, and monthly lower lows. Then we get painful moment number 1 and painful moment number 2. If we compare what the current chart looks like to both of those instances, the trend here is much stronger in the upward direction with still an opportunity for a monthly higher low. Does not seem like on the highest time frame monthly from an investment perspective or positional / really long-term swing perspective that any aggressive adjustments to positions would be warranted. It seems like patience is a good outcome here. As we drop down to the weekly time frame chart, this is where things start to shift just a little bit. Let's keep it status quo and evaluate the candle structure and location as we always do. What do we see here from structure? Certainly a bullish, solid green-bodied bar. On the gap down open from Monday, we basically set the low of the week, and on Friday, we rallied to close at the highs of the weekly range. There's no upper or lower wick to really read into from a psychological perspective, so the structure is of course bullish. But as soon as we start to consider location, it doesn't look so good anymore. On the bar-to-bar count, there's a massive lower high. On the bar-to-bar count, there's a massive lower low. The only bullish thing you might be able to say here from a closing perspective is that the gap closed and we were actually able to close inside of the previous week's range. But let's consider more candles than just a bar-to-bar count. If we're counting weekly trend, we had lows, higher lows, and these were soft higher lows. We had talked about that concept for a while. So what happened on the Monday gap down? Well, unfortunately, it's a lower low in the trend cycle. And now that really opens up the weekly time frame chart for the threat of a possible lower high. So where would this ideal lower high be and what are its implications? Of course, it would change the weekly trend to confidently down. The weekly lower high wants to be set in a picture perfect world anywhere underneath the bottom end of the 2-week balance range over here. However, I would still make the argument that a weekly lower high can be set if we reject the top end of that 2-week balance range. So outcomes that might look like this, or outcomes that might look like this. To change my tone on the weekly time frame chart, I would want to see some sort of weekly close, and I'll even come in here with a green bar, that looks like this. Now, am I convinced that this is a high probability outcome for the coming week's worth of trade? I would tend to think not, but closes over the top end of this previous 2-week balance range back here is what it's going to take to play devil's advocate and say, no, everything's fine and dandy, the weekly crisis has been averted. That would be over 550 basically flat as a nice round number here. So do we have any confluence that would suggest that there is a stronger chance for a lower high here? I think the answer is yes. Let's bring out the Fibonacci's coming in from this low up to the most recent high, and what you'll notice is that the 38.2 could act as resistance even before the bottom end of the 2-week balance range. If we come in from the last higher low up to this, notice that we obviously made the lower low, but this 61.8 would also keep me bearish here. You could, in theory, rally to the 38.2, and that's still a lower high underneath the top end of the 2-week balance range we were just referencing at 550. So I'm not seeing a clear path forward when using these previous swing lows out of the weekly time frame. The lower high looks like there's some confluence. What if we come in here with the weekly anchored VWAPs? Well, lo and behold, the all-time high anchored view app, as well as the previous higher low anchored view app, both are offering confluence at the bottom end of the 2-week balance range. So if we see a rally, again, in the very, very immediate term, we'll talk about the hourly in just a second. If we see upside, that's fine, but I wouldn't forget about the opportunity and the offering of a weekly lower high to keep the bears more in control of the S&P 500. We talked about what it would take for me to change my tone, and it seems like lower probabilities, a weekly candle close over 550 over the next 5 trading days. Let's come in here with the volume profile as well, because this also supports the thesis of a lower high being set. We only need 6 months of data, and if we zoom in here on the action, what you can see is that the high volume node overhead is the bottom end of the 2-week balance range. A great place to get a low volume node retracement, find rejection off of that high volume node. You could think of this as trapped overhead supply, trying to sell for as close as possible to break even, set that lower high, and the trend on the weekly is now down. That's the medium time frame weekly. Let's go on down to the daily chart though. Start to get a little bit more nuanced here. So first things first, let's evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right hand corner. If we're contained by the upper bound, the number is 545 flat, basically, and I would make the argument that that is still underneath the weekly lower high zone that we were just referencing. If you want the exact level I would use, it's 547. You can see that in this most recent interaction, it was previous resistance, we broke, and the buyers completely failed to materialize over that level and save the broad market. So if we were to get something that looks like this, there's your weekly lower high. On the lower end of the weekly expected move, we have 521 flat. That basically puts us into what I would consider a choppy range from the midpoint of last week, and probably favors more of a bearish continuation move, noting that to get there, you've likely achieved a lower high off of this level, and you're here, and now this becomes a threat for equal low breakdowns, and we'll see that on the hourly in just a second. So the daily trend, of course, is down to where we have highs, lower highs, and I'm thinking that lower highs can be set on the daily chart anywhere, ideally, underneath the bottom end of this balance, and I would even give it wiggle room into the gap fill reversal over 537, closes at 539.50 gap fill reversal. You would look for a pullback, and I would argue that your short entry, the short thesis, really steps in underneath 529.50, the Friday low of day from now 2 weeks ago. It's actually, ironically, very close to Friday's low from last week also. But under that level, I would start targeting 518.75 and continuation into the equal low from Monday's open at 512. Now, volatility has compressed a little bit. You'll notice that this week's expected move is slightly smaller than last week's expected move. So this doesn't have to happen over the span of 1 week, but the structure still supports multiple opportunities for a lower high, the weekly lower high, or even the daily lower high on the gap fill reversal. So the daily pathing would be as follows. If we move into here, I would look for a rejection and a breakdown into the range, and ultimately, this is what we're looking for going forward. If we move higher than that, I would change my tone to being slightly more neutral in this area here. I would be open-minded to, okay, and this is more of that devil's advocate component, if this takes place, maybe we'll change tone to say that we've got ourselves a massive inverted head and shoulders, and over the neckline, I would be back to bullish on the weekly chart as well as the daily chart. That's what's required here for a large trend reversal. As we've already made note, over the span of 5 trading days, I would tend to think that this is a lower probability outcome into next week. However, just pointing out, again, devil's advocate, I will be back on the bull side of the market if we find a higher low over 537 inside of this range. This would be a huge failed breakdown and failed accelerant to change the weekly trend if that takes place. My primary outcome probably revolves more so around setting this lower high here and then coming back down into range under 529.50. Ultimately, we're trying to navigate back down to the equal low at 512. That preserves the trend being in the downward direction on the daily time frame. Obviously, if this does not hold for a higher low, and let's bring out the red crayon here because this would be pretty detrimental, this, as soon as we pass back through this level right here, could also be a short indication from the higher time frame weekly perspective for the same outcomes here. Maybe a little dance, and then under 529.50, ultimately, we would try to navigate back down towards 512. So that's what I'm seeing here out of the daily time frame, and it really revolves around this as a very meaningful pivot on the weekly if things are going to reverse and become more optimistic. I'm not sold on this idea yet, and we'll get into that as we get through the supporting evidence in today's episode. Let's go ahead and also bring in here an alternate, I'm not really a fan of trend lines. If you've been around the channel, you know this. They're a little bit more subjective, but as we do something that looks like this, depending on how long this rally potentially takes, you're going to have a cluster of resistance for that possible lower high in this zone. Don't forget that this daily 50 SMA is, because prices are below it, slowly also going to move in the downward direction here. So overall, I think the resistance trend line, the bottom end of this balance range, it's a real threat. And just to talk about the actual horizontal level once again, that is right here, the gap fill reversal at 539.50. Let's go ahead and bring this on down to the hourly time frame chart. Let's talk about what happened into the end of last week. So on Wednesday, there was a pretty decent move in the downward direction, gap fill reversal off of the Friday low from last week. It closes the weekly gap, and we also broke a minor trend line here. So if we put ourselves in the shoes of sellers, they really should have capitalized on the Thursday morning open to yield consolidation. Now we have an hourly head and shoulders, and then a breakdown through the equal lows. Obviously, that did not take place, and I will raise my hand and I will say that the Wednesday afternoon video was perhaps a little bit too aggressive looking for this bearish breakdown, but regardless, it doesn't change the daily trend. We're still in a daily downtrend. Now, if this is going to act as an hourly double bottom reversal, we're technically over the neckline, and I would say that if we can hold consolidation over 529.50 and we can get acceptance over 532.50, the gap close overhead would not be unreasonable. But on the daily time frame chart, I would still maintain the stance that I would be a bear here looking for a lower high to be set. So what could we read into that would start to suggest that we don't really have new money buyers stepping up in this market? Well, if we had really aggressive buyers, or if shorts were going to squeeze out of this market, then Friday's afternoon price action should not have unfolded the way it did. If you look at what happened on the Friday session of 2 weeks ago, we built a flat top and we rejected that on the Wednesday highs. As we started to poke above that Friday afternoon, you would tend to think that a flurry of short covering would come into the market. You would also get new money buyers really excited to trigger new highs up and over the double bottom neckline. What happened on the very next hourly bar? The market immediately came back down into range and went sideways into the close. From an enthusiasm perspective, from a momentum perspective, this is not the reaction that you're looking for if you're trying to spot either short squeezing out, which takes selling pressure out of the market, or new money momentum buyers looking to establish new positions. We did not get that over the structural break at 532.50. So for that reason, I think that this is a bearish data point to say that, okay, counter trend drift can continue, but I would look for the sellers to try hammering it again off of 539.50 for a rotation in the downward direction. So here's some explicit pathing for you as we walk forward. This is my take. I would be looking for a double top, and again, head and shoulders would work there. Simple hourly inverted hammer works. Here we go with the head and shoulders, just so we're all clear. Then I would look for a move back here. And then really, the shorts accelerate underneath this level here at 529.50, and the main target would be these equal lows, which are really deficient from a structural perspective at 518.75. From there, I would expect maybe a small counter trend move, but any subsequent tests really bring us into that 512. Once again, I want to acknowledge that the weekly expected move has contracted. As we'll see out of the VIX, volatility has also contracted, so this does not need to happen in the blink of an eye. But I'm maintaining, probably mostly from the daily time frame chart, more of that bearish edge here, favoring the trend continuing in the downward direction. If I'm going to change my tone, once again, we'll play devil's advocate, it would require the green crayon first of all. We would need a huge rally through the gap close, a higher low being found over likely 537, and continuation into this level here. If we break out over 547, I will have had to have changed my tone at that point from the daily, and this is how the pathing might look on the hourly time frame. Any sort of opening drive is very obvious to the downside, I should preface, right? Any opening drive to the downside with lower high under 529.50, again, very, very straightforward. Failed squeeze from the shorts, failed new money buyers really stepping in on momentum. This is almost a no-brainer short in my opinion, back down to the equal lows, if not looking for follow through into that 512. What do we see here if we bring out any confluences? with the Fibonacci's and, of course, the intraday anchored view apps. Well, from this point of view, the 61.8 from the Thursday capitulation from, what was that, 2 weeks ago now? The 61.8 is right here. Gap fill reversal makes sense as the final line in the sand. When we're set to change our tone and when I will raise the white flag and say, hey, markets are back in full-blown bull mode, that would be a recapture of the 61.8, right? If we're just back to the downside, excuse me, underneath 529.50, I mean, it's not perfect confluence, but the 38.2, failing that, starting to look for these targets down at 518.75, that certainly encourages more of this look remaining as a bear flag, right? Looking for a breakdown over time. What about the intraday anchored view apps? What do we see from this point of view? Look at that. This, I believe, is the all-time high anchored view app. It absolutely is. Look at that. Beautiful. That is perfect confluence with the daily lower high zone, 539.50. That's awesome. If the counter trend move does take place to get here and we reject, likely that would cause this to curl higher. And the breakdown, as we've already noted, is back down through 529.50. Great confluence, maybe an intermediate target here that's coming from the lowest low on Monday, but still, target should be 518.75 more appropriately from a structural perspective based on everything I can see. You want more supporting evidence? Well, good thing. I've got plenty of it up my sleeve here. Let's jump into the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. On the Friday session, where we attempted to break out over the double bottom neckline here, right? And we just talked about this on the hourly chart on the SPY. What were the volume flows doing? They were flat, not impressive at all. Net flows on the week ended up neutralizing. I would call that negligible to the downside. But what about the actual breadth ratio on the Friday session? Was that improving or decelerating during the session? It was basically flat. What I'm getting at is as this breakout was taking place, you were not getting exchange-wide participation in the upward direction. You had breadth that was more so stable and stagnant underneath 2. It never moved over 2 in the upward direction. That's not really indicative of new money buyers stepping up saying, hey, this is a buyable dip. Oh my goodness, markets are headed back to new all-time highs. If we look at the advanced decline line, it was tangled at the zero line all day. It never made a trending advance towards trend higher zone up towards 1500. But it also didn't move down here. So I'm not saying that this is like doom and gloom on the hourly at least. I'm still bearish the daily chart. I want to be very clear about that. But not doom and gloom on Friday session in particular, but we don't have stronger buyers is the main illustration. If you look at the index score, which I'll just remind you one final time, is now available on the website. It was pretty weak through the day's session. Now, it was not weak enough to the point to actually suggest a short and be negative, but a stronger trending day in the upward direction. If you just look back to what happened on Tuesday, of course, back here, this is going to be reading up and over 15, up and over 20, not even close on Friday session. A really weak display up around like 8. And remember that I've updated this. Instead of reading out of 25, it's out of 30 data points now walking forward. So that's not a strong new money buyer indication. And even if you don't want the index score, and maybe you've already picked up the cumulative tick, this is all over the place. So at the exchange level, was there any sort of agreement among participants that the market was more bullish versus bearish that day? Absolutely not. This is one of the more flat cumulative builds I've ever seen out of the tick. So no new money buyers is the name of the game, just trying to reinforce the type of participant we're seeing in this market, which in my belief really reinforces the daily stance remaining bearish until proven otherwise. If we're playing devil's advocate, this would want to trend up over 300 million. You would want to see the advanced decline line up here in trend higher zone all day with a really strong index score. You would want the cumulative build to be up and over 5,000 by the day's end. Did we get any of that? Again, the answer is no. And I'll be on the lookout for it this upcoming week, and I might have to change my tone if we see that. But currently, we do not have strong buyers participating in this market. If we look at the market profile, if you're not familiar with this dashboard or really chart type, check out the video tutorial in the top right-hand corner. What I find most interesting about this is as soon as if a pullback takes place, you're going to have a ton of overhead supply. Notice that the point of control and value area migrated higher on Wednesday's session. Same thing on Tuesday, really, as well. On Thursday, it's certainly higher, completely contained, but still higher. And then on Friday, it didn't actually, if we just do something that looks like this, the point of control is right at your Wednesday and Thursday high. It didn't move higher. Notice that H and I period tried to explore higher. There's not a lot of volume commitment at those levels. Again, we saw this and we talked about it on that hourly chart trying to break out into the afternoon that failed, right? The volume commitment is lower. So if we were to take out Friday's low, it really opens the floodgate for all of these traders to be proven wrong if they're trying to sort of buy this and look for a market moving back in the upward direction. And that, of course, is going to yield lower prices. You have a poor low on the Friday session, possibly in need of repair. So once again, I would really be aiming at Friday's low. Any sort of counter trend, great gap fill reversal, and then starting the short sequence underneath Friday's low for follow through in the downward direction makes a lot of sense based on everything I can see. If you don't want to short Friday's low and you're like, it's not really enough for me, then look no further to Thursday. Look at Thursday's single prints here. If we break down underneath, loosely, let's just call it 5,300 in the ES, there's nothing there from a volume commitment perspective on Thursday's morning open, right? That little dance we did on the pullback lower wick. If you move through that, I would tend to think that, again, these equal lows are in jeopardy. This is a mechanical level, and that should break on its first test. And then again, more single prints, a period of Monday, all the way back down towards the opening print. So the market looks more so susceptible in the downward direction compared to aggressive in the upward direction. Again, I want to remain as balanced as possible here. You could make the argument that value area shifting higher shows an attempt at price commitment, making higher prices. But again, when I think about what happened on Friday's session, you cleared the previous Friday's value area high. That's this. You didn't see follow through. There was thin structure above and even more gap to close overhead. It doesn't make sense to me that stronger buyers or shorts are squeezing at this point in time. So that's specific to the ES, and we have more information as we walk through the sectors, posture, supporting evidence, so don't go anywhere, but let's do the same thing now for the QQQ NASDAQ 100. Let's start on a monthly, and we'll speed it up here a little bit. We'll try to save you a little bit of time, but for the most part, we want to be thorough in the investigation. Monthly high or low, certainly a possibility. Is the trend down? The answer is absolutely not. So all set on the monthly time frame, encouraging patience and really no major adjustments. As we drop it down to the weekly time frame chart, rinse and repeat of what we described out of the S&P. Solid green-bodied bar, negligible upper and lower wicks. We closed inside of the previous weekly range, but on the bar-to-bar count, massive lower high and lower low. We did interact with the weekly 50 SMA. That's a positive indication. However, this is a massive lower low from a trend perspective. Look at the amount of distance that's available here for a possible weekly lower high underneath the 2-week balance range. Certainly seems more like a threat to me compared to a major opportunity for a reversal in the upward direction. I would want to see the weekly trend get up and over this level for me to become more confident. So again, do you believe, and this is just the question you have to ask and answer for this week's session, if you're trying to be bullish, do you believe that a weekly bar is going to look like this with a close over that pivot point? And to give you a number here, roughly 474. I would not be as worried about the top end of this sequence just because of the amount of distance that's still here specific on the NASDAQ marketplace. So does this seem like higher or lower odds into the upcoming week? I don't know about you, but I would tend to side more so with lower probabilities for the next 5 trading days. If we bring in the Fibonacci's from the bottom end of the move up to the top end, you're basically closed right at the 61.8. The 38.2 is well below the bottom end of the 2-week balance range. We can come in here with the anchored VWAPs on the NASDAQ. This is at or below the structural element. So again, great spot for a possible weekly lower high threat. And we can also come in here with the volume profile and ensure that we are not missing anything. We're not. I've done the homework. Don't you worry. This is a high volume node. Low volume void, even here, you might run into some struggle. To get you that number, that's going to be closer to 459.50 on the weekly time frame chart. A threat there for a lower high. So these two are the major watches on your NASDAQ weekly. Let's drop this thing down to a daily. Let's get more nuanced and granular. This is the QQQ, yes. Weekly expected move. Let's dive into it. Maybe not that close. There we go. A little bit of context never hurts. So the expected move high is going to be at 464 flat, basically, and the expected move low is at 436.80. I suppose you might make the argument that this is a possible higher low, but this is still a lower high. I would still make the argument that you're ideally looking for this 459.50 to stay below the bottom end of this balance, but the 2-week balance, that weekly lower high as we were just describing, is up here at 475 to actually prescribe, more concrete numbers to those areas. So from the daily structural perspective, there's a little bit more of a range to travel here for that lower high to be set. And I would be thinking about acceptance on the daily and hourly, which we'll see in just a moment, over 448.15 might continue to yield a possible counter trend move, but we're still coming from the lowest low in the trend sequence, meaning that your daily lower high is certainly possible here. Just from a very simple visual perspective, we have highs, lower highs, lower highs. This would be a great spot for a lower high on the daily time frame chart, keeping all of this as overhead supply if we come back down. To play devil's advocate here, because there is more distance between where we're at currently and that possible daily lower high, I would say that the buyers would want to see something that looks like this. Maybe a pullback here, if it can support, is then a daily higher low, and now we're more so in a compressed phase out of the market with a neutral trend. That would neutralize things here, but I would not yet be bullish until there's acceptance over that 459.50 on the QQQ NASDAQ 100. Obviously, if there's an opening drive on the week or something early on in the week that looks like this, that's the same sort of outcome, and again, you would be bullish on the breakout up and over. Again, this is very speculative, but that would be 467 here. More so to the downside, maintaining the bearish stance that I've been a proponent of on the daily time frame. My thought process would be as follows on the daily. You come here, you come back down, you test this area, but more so find consolidation and weakness. Any breakdowns underneath 446.50 targets the equal low from Tuesday and Wednesday. Daily 200 SMA will be there as well at that point. That's 433.50, and then follow through gets you into the Monday low. If you're a trend follower in the market, this is the ideal path to sustain the daily downtrend that we're in. So we've played devil's advocate. We know what my primary thesis is, aka this one on the screen right now. Let's drop this thing down to an hourly time frame chart and see what else we can learn. So on Friday's session, we got similar to the S&P 500, but we didn't really break back down underneath and inside of the morning range, never mind the range from the Thursday afternoon. So a little bit stronger on the hourly time frame chart, looking for possible follow through to again close the gap or maybe even go a little bit further. Remember, the S&P lower high is the gap close. The NASDAQ lower high really wants to account for more so this balance and possible overhead supply at 459.50. So lower highs up here, then come back down, weak consolidation, and shorts just really start to step on the gas again for something that looks like this. Now you could say, if you can spot the reversal up here, if you're confident and comfortable in your capacity to spot that reversal pattern, that would be the most ideal risk reward, right? Your risk looks something like this. Your reward is firstly down to here, if not trying to balloon some runners into that 433.50, and then beyond that even into 424.75, the opening print of Monday. That's the ideal trade right here, the range we're trying to exploit as bears. If you're a buyer, if you're like, Matt, dude, like take the bear hat off, dude. Just get back to how you used to be. You used to be so bullish and optimistic on this market. Well, here's a hint for you. We're really optimistic when the daily trend is up. We're really pessimistic when the daily trend is down. But if you're saying go back to the bull side of the market, then you're probably not participating here. And instead, what you're looking for, again, devil's advocate, is sure, you get some sort of pullback off of this, but you're changing your tone to bullish here. And you're, as a bull, trying to participate in the opportunity for a potential reversal in the upward direction that looks like this. So these two key locations are really top of mind out of the NASDAQ this week. This little zone right here, I would use the bottom end of it at 446.50, and this up here as your daily lower high at 459.50. This yields continuation. This pullback here looks for the pullback to here. Ideally, we get this. Now I just sound like a broken record. I get it. But if you're a bull, you're looking for that. All right. So pretty clear on the outcomes. And again, based on some of the supporting evidence we've already seen just in the S&P 500, I'm not convinced we have, strong new money buyers here. I'm not seeing it at, any level of the data points we really interpret and examine. Let's come in from the previous high to low on the Fibonacci's for the Qs, and we can see that the 61.8 is mixed up in here towards our daily lower high zone. If you were to, sort of reject off of that, would keep us bearish. And of course, breaking down below this sort of gets us back below the 38.2, making sense from a general, let's just call it thirds perspective. And if we drop in the anchored VWAPs intraday, great confluence, you get this, and this over time, if we're above making the counter trend, will be confluence here to sort of either support if you're bullish or expedite the breakdown and cause a larger panic to the downside. So all set out of the anchored VWAPs. Let's check in on the NASDAQ internals and see what's going on over here. You'll see the same thing, flat on Friday, even bearish on Friday out of the advanced decline line, and bearish here out of the cumulative tick as well. So I know I might sound like a broken record, but does the supporting evidence really suggest that we have stronger buyers trying to step up at this location in the market? I don't think so. I would have imagined stronger buyers could have resulted in a stronger move to the upside, a more explosive move to the upside, pinching out shorts, or even just trying to apply momentum. It didn't happen. If we take a look at the market profile, let's jump on over to the nasty NASDAQ side, and we'll get this back to a more reasonable approach. I would take the same sort of outlook as what we described in the ES futures. Let's bring that off to the left and do that. There we go, a little bit better. The fact that the value area has certainly progressed in the upward direction. The fact that we looked over this and the point of control did migrate higher out of the NASDAQ, that might be worth noting over here. Maybe it's a small feather in the cap for the bulls looking for the counter trend to continue, but the asterisk on that statement is that I specifically said counter trend. The daily trend will still remain down, even if this moves in the upward direction. But any sort of breakdowns under Friday's low really yield all of this, and this as overhead supply. And we do have that thin structure underneath loosely 18.3 here in the NASDAQ from the P post period of Thursday. Right? So P as in the shape of the overall profile here, breaking down underneath and to get into the post would be bearish. That's 18.3 out of your NQ futures. So not seeing many bullish data points to lean on there, other than the only one I've seen so far is the point of control over the high of Thursday and Wednesday. That's a small feather in the cap. But let's jump back on over to the platform and let's continue this investigation, because this is really, this is a very dynamic market right now, I think, to say the least, with a lot of moving parts. So the next one to watch for is going to be your IWM small caps. Let's go out to a monthly time frame chart. And here on the monthly time frame, of course, we're not really at the same structural level as the S&P and the NASDAQ. We've known that for a while. We're not at new all-time highs. This is still acting as a bit of a struggle zone. What I want to point out here on the monthly is just the utmost importance of this level right here. The $200 level, the top end of this balance range, it was tested in this most recent breakdown, and it needs to hold as an area of support. Otherwise, the largest threat, the biggest concern I could see for the broad market as a whole, is if small caps produce a look above and fail, accept back into the range, and rotate all the way back down towards the bottom. Now, I'd prefer if that didn't happen. However, that pattern gets dangerous for your S&P 500 in particular. Let's drop this thing on down to, so maybe more nuance and more concern. Try to be more nimble out of small caps, noting that they're testing a key level, whereas the S&P and the NASDAQ are not even close to really testing those key levels. They have plenty of wiggle room to still yield monthly higher lows. Not the case in small caps here. As we drop this down to a weekly, and I will clear up the drawing set so it's a little cleaner to look at, I do want to go out to let's go for a 5-year chart, because we also want to be able to see the anchored view apps from the sickness lows. The take here is that we closed the gap, but we were not able to close the weekly range inside of the prior pretty devastating red bar. You'll also notice that we're still contained inside of this choppy range, which in essence is still an attempt at the monthly high or low we were just suggesting, but it's already a look above and fail here. The opportunity for a weekly lower high is very obvious, up against about 210, 209.75 is the refined level we've been using on the daily. So that, of course, is a concern. If we bring out, let's take a Fibonacci perspective here, from the top, previous all-time high, down to the low, where did we make it in relationship to these levels? Well, we're sort of inside of that consolidation zone. If we reject the, again, top end of this range, it's loose here, but that's a rejection of the 61.8. That would dramatically reduce the odds, if we just stay stuck in no man's land, that we're going here. We would increase odds the more weekly bars that we can close up and over. Again, let's just round off. Let's call it 213. Over the 61.8, that becomes more optimistic. We're just not there yet from a structural perspective. And once again, I want to reinforce the idea that the small caps, unlike the NASDAQ and the S&P, did not close within the previous weekly range. If we take this out, the 38.2, the bottom end of this consolidation, you've lost your monthly higher low opportunity at 200. That also is a big threat. Let's come in here with the weekly anchored view apps. We've been talking about this cluster for quite some time, but that's appropriate. And what I really want to focus on, I know this is a very short-term anchored view app, but this is at the top end of the balance range, right? Very close. You can see the actual print is at 210.19. That most recent highest high anchored view app could act as resistance for a lower high and keep us more either neutral or bearish out of the higher time frame in small caps. Again, bearish pressure for the S&P 500. So I think as we really bring all these data points together, it's starting to look, again, like I don't think that just calling, okay, hurrah, the bottom is in the S&P 500, it was this big capitulation bottom. I don't think it's as straightforward as saying something like that. I did want to, let's go ahead and clear up this anchored VWAP thing as well. Let's go back to a 50 and 200. And I wanted to jump on over to the KRE because this too has been a watch, simply noting the relationship, right? Interest rates are coming down. You would expect regionals to do better, which they did initially, but look at what happened on the previous weekly bar. Sure, the gap down is devastating just like all the other markets we've watched so far, but is there any attempt to get up and into the previous weekly range? And most importantly, how did we fare based on this previous pivot high? To me, staying underneath 53 in the KRE continues to suggest that there are more fears about that R word, and this is not just about the yen carry trade exploding. Sure, that could be the catalyst as volatility to spark things in the first place, but if the KRE is below 53 and interest rates continue to move in the downward direction, I'm not sold on a very strong, like, okay, fine and dandy, everything's good to go in the S&P 500. So this has been a little bit focused on the intermarket relationship on the small cap side of things. So we'll try to speed it up and make up for some time here on the daily time frame. So upper bound of the expected move 212.89, lower bound at 203.03, which is the monthly higher low area. It's towards the daily 200 SMA, which will be creeping higher. You'll notice that we did not get a Friday breakout like what we saw in the S&P and the NASDAQ. So this threat here is certainly top of mind. Any rejections of 209.75, weekly lower high, obviously a daily lower high. The daily could even suggest a lower high on a gap fill reversal. But let's play devil's advocate. I promised you I would do that in the intro. Here's devil's advocate. If you could get a higher low over the weekly lower high offering, which is currently the top end of that long-standing range we were just evaluating, that's 209.75, I would be forced to change my tone. I will say, hey, waving the white flag, no longer bearish here. We're looking at a more constructive move out of small caps. That is going to help the S&P 500. So watching that quite closely. But for now, this is just bearish consolidation. How could it not be? Huge overhead supply, gap never closed underneath the top end of this range. No semblance of support on the test there. It's bearish, or at least if you're like, I want to be a little bit more neutral, maybe neutral to bearish, but it's definitely not bullish at this point in time here out of smalls. Let's take a look at the hourly time frame chart. You are getting a little bit more of an indication of a pressure cooker top with this high and tight consolidation on the hourly. So it might not be unreasonable for early in the week an attempted break, but still looking for that lower high opportunity here to keep the markets more bearish. So that would be a primary watch early on in the week, and the possible catalyst that, of course, the IWM will be more sensitive to will be PPI as well as CPI. PPI is Tuesday, CPI is on Wednesday at 8:30. Inflation numbers are going to wreak havoc on this market, I believe, from a volatility perspective, if we miss. Now, I don't believe we're going to miss, and I'll show you why in just a moment, but that's your IWM hourly. What do we see from a Fibonacci perspective, just to quickly check in on any confluences? 38.2 rejections are right around in this area. That makes a lot of sense to me. Even a gap fill reversal keeps us underneath the 61.8, so I'd be very hard-pressed to say anything bullish about this market, so long as we're respecting these levels that we've really outlined so far. Let's bring out the intraday anchored VWAPs. Not much to comment on here. Again, this is looking more so, I will acknowledge this, a pressure cooker top, like it could possibly break with the subsequent higher lows. So we'll see, but still thinking about this in the context of a counter trend move in the overall downtrend that has certainly started to emerge on the daily chart, right? Let's go ahead and look on over at the Russell internals just to see if there's anything that we should make note of. Again, we know that the Russell was actually more sideways, so these internals are a bit more appropriate, noting that they're bearish, whereas we had more of a divergence out of the S&P and the NASDAQ. If we check in on the, let's go on over here to the market profile. What else can we learn? Let's scrunch this thing up. Let's see what's going on with our value. Value is, it's over. So this is actually somewhat interesting, and I would say maybe a small feather in the cap for the bulls, supportive of more of that pressure cooker top thesis. On the Wednesday session, point of control and value were certainly lower in the session versus the S&P and NASDAQ, which were higher in the session. So if people were accumulating shares down here of small caps via, IWM or whatever, then that possibly means that these longs are feeling happy, and it's not as likely that overhead supply instantly flips. Now, you do have value here and value here from Thursday and Friday, but if these positions were put on, that is going to be, again, possibly suggestive of more of this opportunity to break for the counter trend move possibly continuing. So carry that forward out of the Russell in particular. Let's jump on over to the sector analysis for our S&P 500, and this is where I would argue we fall right back into the bear category. Let's take a look at the weekly performance first, and then we'll get more nuanced because this is deceiving from a trend perspective. XLK Technology up 7.15%, pretty impressive. That's the heaviest weight risk on sector. XLC Communications, not the heaviest weight, but it's still risk on, up 4.6%, followed by discretionary, up 4.36%. All of that looks good at face value, but as we'll see on the structural charts, not so much. TLT is down on the week, down 3.44%. And I suppose if you were to measure this from the previous weekly close, this is going to measure from the weekly open, it would be certainly a different read here. But anyways, at the bottom of the barrel, TLT, excuse me, and the XLU, utilities, the most bond-like sector. Let's check in on the structural charts. Is the posture actually improving? Should we read into this as being like a huge indication that, oh my goodness, Matt, it's, how could you be bearish? This is being led by technology. Not so fast. Not so fast. What does the technical structure really suggest here out of the trend perspective on the technology ETF? Not doing anything impressive over 212. Sure, you're getting, again, this little compressed flat top. Maybe there's an opportunity for the counter trend to try to break out over it. But any lower highs below 212 are nothing more than a daily lower high and like right up against the resistance trend line too. So I'm not sold on the idea that this is a miraculous bottom and everything's cleared for takeoff. To play devil's advocate, I would want to see a break over 212, higher low above, and then I'm probably like, okay, more confident in long trades, changing my tone back to bullish on a breakout through the inverted head and shoulders neckline. That would be 218. And that's very speculative in nature. My primary thesis here would be, all right, reject 212, keep the daily trend down. I'm not really seeing a whole lot of risk appetite improvement in this market. And we'll get to that in just a moment. So that's that. If you're curious why 212 and not the exact lows of these bars, just take a look at the hourly chart, right? Attempted rally higher, failed. Attempted rally higher, failed. If you go back to the daily time frame chart, 212, of course, represents the top end of the previous balance. So that's why 212. If you get a lower high there, detrimental. So we've played devil's advocate. Let's move along. XLC, I would be a little bit more impressed with the XLC. Moving all the way back up to this inflection point. There's certainly the opportunity that any consolidation here would at least change me to neutral, if not trying to remain optimistic. But the XLC is not in the top 4 heaviest weight sectors of the S&P 500. And therefore, I would not make the argument that this is as important as the possible threat of a lower high in the XLK. So anyways, 85 is your big inflection point. Probably want some cleaner resolution of that. If it does reject, then don't get me wrong, it's just nothing more than a lower high, and the bearish sentiment persists. So if I'm going to be bearish, great, reject 85. If I'm going to be in here, maybe neutral, but not full bull for the market. XLY. Obliterated? Anybody? Huge lower low? Maybe I shouldn't say huge, but on the gap down, certainly a lower low underneath these pivot lows. Tried to find acceptance above. Anything that rejects 177 is bearish. Anything that closes the gap overhead is bearish for a lower high. I'm not seeing the argument for a bullish outcome here. I might flip to neutral. Again, this is neutral. This is not even bullish here. This is neutral on the XLY if we try to then hold over 177 if there's a gap fill reversal and we attempt to hold it there. Neutral, not bullish. The uptrend would have to be clear and well-defined if I'm going to change my tone, and that might look something like a higher low double bottom, but that would require being over the neckline after the higher low has been formed. Can you see how this is like very speculative? It's very prescriptive. It's not worth being overly, this is my take at least, I'll speak for myself, you do you. I don't think it's worth being overly optimistic unless we actually have these signs that a more firm and concrete bottom is being hammered out. Here's the XLE, lower high underneath the neckline possible here. Lighter weight sector, but has much more to do with global growth, if you will, and demand for oil. So below this neckline, I'm still somewhat concerned. Again, R word comes to mind, recession. Industrials, give this thing the benefit of the doubt, midpoint of the range. And it's unfortunately not a really heavyweight component of the S&P, so I'm hard pressed to say like, oh my goodness, rock and roll, new all-time highs. This would be bullish. Maybe a new pivot high up and over, pivot high or low, I should more appropriately say. Over 126 would change my tone a bit. Financials, decent attempt, but what's the concern? By attempt, I'm thinking about, okay, you rallied off of the lows. That's a great first step. But now there's two things that need to happen. Number one, you need to offer a higher low over the neckline, which certainly failed on the initial gap down. So higher low needs to be here over 41.75. Point number two is that you need to now break out through the neckline and this possible level here at 42.50. I'll change my tone if we get this, certainly. So any higher highs earlier in the week over 42.50, I'll change my tone and look for this. If we pull back first, it's a two-step process. You need to support here and you need to break out here. 41.75, 42.50. As of right now, sort of more maybe neutral out of financials. It's definitely not as bearish as the technology sector. Semiconductors, Geez, this is because it just starts with a one handle, and Thinkorswim apparently is not good at math, but up 11.88% on the week. That's as measured from the low of the week, the opening print of the week, not the previous week's close, which would have been here. Obviously, if we measure, so here's where this is deceiving, right? This reads up 11.88%. Technically, this would be up 2.92% on the week if you're measuring from the previous weekly close. So do with that what you will. Structurally, right, the threats are as clear as day. Bottom end of the balance range here, lower highs at 230, gap fill reversal, bearish, right? You're already getting an indecisive doji on Friday instead of accelerating up and over the Wednesday and Thursday highs. If you move further than that, you're looking at 237, lower highs there, reject this, and this. If you take a look again at the hourly chart, very similar to the XLK, there is the bulk of the overhead supply. So I'm not seeing a clean path forward yet for these semiconductors, a huge component of the broad market currently. To play devil's advocate, you would need to see something that at least looks like this. Step 2 would need to be a breakout, so a two-step process just like your XLF. Let's move through the real estate sector and the remaining sectors a bit faster. Neutral, again, swing highs are important here, really lightweight sector, not reading into it too much. XLV, healthcare, is a risk-off sector. It's up here inside of this consolidation. It's producing a higher low. It's defensive, so that's great that it's holding up. It's more of a risk-off indication, but it's also the third heaviest weight sector by market cap. So the S&P might not completely collapse if healthcare is staying over this 147. If you're, and this is a note to self, right? If I'm trying to be really bearish, looking for more follow-through to the downside, I probably want to get the XLV under here and look for a continued deterioration. But do recall, this is D for defensive, so if anything's rallying, healthcare makes sense a little bit, even if the broad market is going to continue in the downward direction. Next up, materials. Oops, skipped one. Materials, the lightest weight sector in the S&P. No comment. Lower third of the range. New swing low would be more impressive. XLP is D for defensive, so similar commentary here as the XLV, but this is not the third heaviest weight sector. This is way down there in terms of ranking, so the defensive posture here makes sense. It looks bullish in this range, but a breakout here does not suggest risk-on nature for the S&P. We could look at the TLT. There was a severe pullback, and again, I think that's fine given the nature of the Monday move to get here and even higher. This is Friday of last week. Here's Monday. So pullback's fine as long as it stays over 94.50, which I believe it will because of how the Fed is poised to cut rates. I would tend to think that this is defensive, especially if it is to some degree, and we'll see this on the ratio chart in a second, outperforming the S&P. Here is the XLU holding up high and tight, which is fine. Again, this is D for defensive, but it's a lightweight sector. So even if it's bullish here, again, it suggests more of a risk-off posture. It's not going to help the market move higher. That's for darn sure. Let's jump on over to the ratio grid and see what's actually going on here. If you're not familiar with this dashboard or this screen setup, check out the video tutorial in the top right-hand corner. This is screaming risk off. Big downtrend out of the XLK. We saw the structural chart. This is deceiving here with the weekly performance as measured from the open. This is screaming risk off. This is saying, okay, you have one saving grace out of the XLF, but we just talked about the two-step process that's required if the structural chart is going to play nicely and agree. This is saying risk off, this is saying risk off, and this is saying risk off. So there's only one thing here that's saying we might be all right. Again, probabilities-wise, I would tend to side more so with saying the bears still have control of that daily time frame chart. I'm not convinced that everything's fine and dandy yet. Again, if we're playing devil's advocate, this needs to bottom instantly, find a move to the daily 50 SMA and possibly higher. This needs to go over the 50 SMA and at least trade into the equal high because this was already in a long-standing downtrend. You need to put in some stronger trend reversal here out of the ratio in discretionary. That's devil's advocate. Devil's advocate would say this wants to come down. This needs to be below the 50 SMA. This needs to be below the 50 SMA. What do you notice? There's an opportunity for a higher low here. There's an opportunity for a higher low here. Devil's advocate has a lot of work to do. Let's take a look at some other ratios here, some specialized ones, risk on versus risk off. Generally, we want whatever direction these trends are pointing, that is going to tell you risk on or off. So down is risk off. I don't know about you, but this looks like down, that's risk off. I don't know about you, this looks like down, that's risk off. Again, not to beat the same drum over and over and over again, but all of these are pointing in the downward direction, and it doesn't even look like we have the opportunity for a stronger reversal yet. This looks like an opportunity for a lower high. On a line chart, I do not count this as a double bottom. A double bottom on a line chart looks like this, right? That is a line chart double bottom. So watching out for, just like this is a head and shoulders, and it would not just be like this here is a head and shoulders. All right, so that's my take. All of these are down with opportunities for lower highs. This USD JPY, everybody's now suddenly an expert on the yen trade. I'd like to point out, again, we sort of talked about this 2 weeks before it happened, starting to see the emergent signs of it cracking, right? We talked about, hey, if this gets underneath this level, you can go back and watch the video, we'll have some issues. What does this look like? It looks like a small counter trend move in the context of what is a big trend reversal on the larger chart, right? Let's go to the US dollar just to get a sense for, okay, is the dollar having any impact on this, or is it simply the yen's movement based on the BOJ? Well, the dollar being lower here, certainly not really helping, but the dollar's been stable for the remainder of the week, right? Let's take a look at the /6J, and this is going to be your Japanese yen. This is really where I'm tracking this more closely. We've talked about in the pre-market preps how from point A to point B, this huge move in the upward direction, the pullback has been over the 38.2. From a technical perspective, this is nothing more than bullish consolidation with the possible threat of follow-through in the upward direction. What I would watch for here, if the market's going to continue to see pain in the downward direction, as soon as we get a move over, again, ignore the zeros in front, but 69,186 on the 6J, this is like, probably maybe not equal low, but probably downward pressure for the broad market as a whole. So keep that in mind. The yen is worth watching right now. The correlation is not good. Let me be very clear about that. The correlation long-term of the Japanese yen and the equity markets for the US is not necessarily perfect, right? They can sort of do opposite things at different times. But when something is such a focus, you're seeing it in the headlines, you're seeing everybody concerned about it. Once again, everybody's now an expert in Japanese financial markets and their economic policy. I'm not going to claim to be that. I'm just going to claim to be looking at the technical charts. But because the market's hyper fixated on it, right now the correlation is quite high. And while the correlation is quite high, I would tend to use it while it lasts, right, as an indication. And as it starts to fade, it'll become less and less and less of a meaningful data point. Anyways, that's your JPY. Let's move on over to gold, which is also sending more of a risk-off indication, right? As the market has sort of moved higher here, gold is also saying, hey, we're moving higher too. If this takes out the swing high, why would people be rushing into hard assets like gold, which is typically defensive, as we're moving higher out of the equities market? Oh, I've got an idea. Because it's a counter trend move in the context of a newly established downtrend. That's why. Let's take a look at what's going on over in interest rates. Obviously falling off of a cliff here, counter trend move. Still looks like we can get lower highs to persist, and we know that the Fed is very likely to cut rates. Let's jump on over to the inverted ZT. Again, not a shocker here. So overall, I don't think that there's anything shocking to talk about over in interest rates. Let's talk a little bit more about the fundamentals, though. Here's the Fed tracker tool. The market's been flip-flopping back and forth between a double cut or a single cut for the next meeting here from the Fed, which, as we all know, is in September. And you're going to want to watch this specifically around CPI this upcoming week, which is, of course, Wednesday at 8:30. Do the odds start to favor a double cut or a single? If we come in at the expectations or below expectations, which I think we might, a double cut might be on the table here. And there's two things that would suggest that's actually appropriate. Inflation coming down, and I've got a trick up my sleeve we can look at in just a moment also. If inflation's still hot, probably expect, and by hot, I'm just meaning misses the expectations, but not re-accelerating, hopefully, then a single cut is most likely. This, to me, is inaccurate, especially because, there is no October meeting. We know that the tracker tool is really just a perception component after this. It's most accurate in the upcoming meeting. Anyways, what happened last week that we should key in on, and why might the CPI print be lower? First and foremost, ISM Services PMI came in over, the expectation here at a 51.4 versus a 51.1, but you have to look into what actually happened with PMIs. So if we pull up this chart here, what you'll notice is that the prices paid for, if you look at this right here, let's see if I can get my white highlighter. There we go. The yellow line actually saw an uptick. So prices paid was higher. But also, you're getting employment and new orders moving higher also. So with new orders, prices also moving up. There's more demand, so we're moving prices higher. Whereas when this was upticking back here, you actually had out of the blue line and the green line moving lower. And that divergence, I know it's very small, and this is monthly data, so it's not like we have a ton of it, but this divergence highlighted here is a signal of inflation when those spreads are getting wider. When these spreads are coming together, moving in the right direction, so obviously a lot of new orders, but smaller increment out of prices paid, that's going to be an indication that inflation is not as severe under that circumstance, right? So that, to me, is one of the reasons as to why the inflation print coming out on Wednesday might be soft. If we go back on over to the calendar, the other big news last week was what we saw out of the initial jobless claims, well below the expectation, 233,000 versus 241,000. We've been opening up this chart. We've been talking about it for a little bit more, with a little bit more detail, I should say, over the last little bit, and primarily just to get a sense for what is, if we go back to, where is it? Let's go all the way back to the great financial crisis. Things really get bad as we're up and over 400,000. So when Jerome Powell in his press conference the other day made note that, we're seeing a rebalancing in the labor market, but we really don't want to see much more than this. I think that even though these reads are elevated, it's not so severe where, oh my goodness, recession is underway immediately, right? And I think that this falls directly back to the monthly time frame chart outlook that we were observing. The monthly trend is still up, right? Whereas in the other instances where initial jobless claims were, well over 400,000, the monthly trend was already down at that point in time, correct? So this was sort of a decent saving grace, and obviously we saw the markets move higher on that Thursday session anyways off of the open. Let's go ahead and move into a couple of other components here. This is related to why I said that the double cut might be on the table if we get a soft inflation read. So soft inflation read came from ISM Services PMI. We know services is the sticky side of inflation. But this is the Taylor rule. And the Taylor rule is a sort of amalgamation of current interest rate policy, the rate of inflation, as well as the GDP, the extension of GDP from a linear trend over a specified time frame. I know it's very technical. You can do the readings. You can figure out what that is. But in its basic format, it's those three things as forming a calculation to project what the Fed rate should be. And we actually wrote about this in 2023 during our outlook. All right, so this report was published on our website, on our blog. You can go back and read it. The Taylor rule here, right, we were talking about, was suggesting that interest rates needed to continue to move in the upward direction, and that happened to be right. What I want to focus on here is specifically that the Taylor rule is helpful in determining direction, not absolute value. So if we go back over to the current chart of the Taylor rule estimation, this here is suggestive that obviously to get from a 550 down to, let's just call that a 350 on the rounding error, that would suggest many rate cuts. So this would possibly be a supporting piece of evidence for the Fed being late to the party, needing to double up and starting to cut rates a little bit more aggressively. That is your Taylor rule. I wouldn't look at this as like a holy grail piece of information. I'm not claiming to be special for pointing this out. Obviously, these charts exist, but it's something that might fall into the supporting evidence category for a double cut, not a single, especially if inflation also comes down meaningfully on Wednesday. We just saw that the initial jobless claims looked okay last week. So combining all of this information, the double cut might not actually be a sign of like, oh my goodness, things are breaking, more of a preventative measure to keep the labor market from breaking, if you're a believer that things are not already overdone and it's just a matter of time, right? So that's, I guess, a little bit of the optimistic take here. Let's look forward just so we can, again, point out what's happening this upcoming week. PPI will be a sort of preview, if you will, to the CPI, Big Coffee and Donuts up in the penthouse on Wednesday morning at 8:30. So you can come hang out with us for the pre-market show. We kick off at 8. The news comes out at 8:30. What are we looking at? We're looking at a 3% year over year. Again, based on the services PMI report, I would expect a small move to the downside. I would expect us to come in lighter than the expectations. This is sort of a wild card, I would say, out of that one. But the year over year, I would expect to improve a little bit on this month's read. Retail sales are going to be mixed in this same exact week, August 15th, 8:30. Be prepared for that. We'll have coffee and donuts back to back. Not for PPI. We can't, do it 3 times a week, but 2 times back to back is fine. And what else this upcoming week? This will move the market as well. Friday. Consumer sentiment and inflation expectations. The preliminary read is always more important than the revision. That's what we've got out of the fundamental catalysts. We can also take a look at the earnings insights, courtesy of FactSet. Big shout out to them. Not sponsored, not affiliated, but just putting out a public report like this is pretty generous of them. What do we see out of the actual bottom-up EPS? Pretty flat out of the 2025 read. This one is up here, and they typically get revised down over time. Let's be clear about that. Pretty big drop-off in 2024's full year EPS. And the reason that this is concerning is because even as the Fed is slated to cut interest rates potentially, look at what's going on with PE multiples. They're actually coming down. In theory, right, lower interest rates should expand PE multiples, making them move higher. So that sort of move to the downside is counter to what we would really envision and I don't think really like you're going to need to see what's the bottom line, Matt. You need to see absolutely home run earnings in the next 2 cycles if the market is going to, hold up well. And that's just, again, from a macro/fundamental perspective. And that's the relationship between PE coming down along with the actual earnings forecasts drifting lower as well. Here's Q3 looks like it's absolutely in the gutter, getting constantly revised to the downside, and 2025 is slated to be flat as of right now. So there's some work. There is some work that needs to be done. Who's reporting this week? Let's take a look. I'd say that your biggest players here are going to be Home Depot as an interesting sort of like what's going on from the cyclical side of the economy, right? As we look at Cisco, not really involved in the semiconductor space, but telecom maybe. ATS Space Mobile has been, parabolic over the last little bit, so that's kind of funny that they bumped that one up the list here, but not really going to move the needle for the market. Walmart might have some insights into the spend of consumers. AMAT is related to the semiconductor side of the market. So that is what we have out of the earnings calendar. Let's continue to explore our technicals, though, by jumping back on into our risk appetite chart. So TLT ratio to the S&P still offering the opportunity for a trend reversal. This is an indication of a flight to safety, right? The market is selling off as bonds are getting more, attractive here. Why would people prefer to go into something that is, obviously historically slated to underperform the market if there's a high degree of confidence on the pullback? It's not really the way that would work, right? You would want to see this maybe a small uptick to here, but not this big breakout, of course. So that's the TLT. Flight to safety seems on based on that. Bonds relative to themselves drifting lower, but we know that this is because of the forecast of rate cuts. This is the shortest end. This is the longest end. Notice the difference in the severity of the trend. Pretty much aggressive here, a little bit more flat and stable here. If this is flat and stable, even as sort of rates are coming down, I would tend to think, once again, it's not a clear risk-on indication for appetite there. You would want this also moving more aggressively to the downside on the longer end of the curve. Let's take a look at credit spreads moving in the upward direction here. This is a red flag. This is something that we're noting as a bearish data point. Risk appetite might improve if there's a move back down underneath these prior pivot highs. So far, this is looking like an opportunity for a higher low and a hook higher. The shorter term credit spread, SHY, HYG, this is more along the lines of 1 to 3 years, a little bit more contained here. So my watch would be this one. I would watch this and I would say, okay, I will raise the white flag. We'll play devil's advocate. If we come down here with lower highs and consolidate, I'll raise the white flag. That's it. Game over. Looking for more of a severe bottom in the S&Ps. If we remain above, it's only a matter of time before the shorter term actually picks up. That's my belief. Let's move on over to the HYG in isolation. Counter trend move with a possibility for rejections underneath this. If that does happen to unfold, if we start to see rejections and this sets a lower high out of the HYG, I think it's thesis confirmed out of the S&P as well, looking for that follow through in the downward direction. If we look at Bitcoin, which is a risk asset, this is not a hedge to inflation. This is not whatever people try to spin it off as right now. It's still a risk asset until utility really becomes mass adopted, but we won't go there for today. Lower high possible underneath the bottom end of the range, to me, as a risk asset, that does not speak well to like, oh my God, huge influx of capital coming into the market. If this starts to drift lower, that would be bearish, and the devil's advocate would be really just more neutral in here. To be bullish, I would need to see a new breakout to new highs with acceptance over 74,000. Let's move along to, let's go to the new breadth chart, total breadth, and see what's going on from this perspective. We'll zoom in a little bit. So if you're trying to remain bullish, if you're trying to be optimistic, and I think that this is more appropriately related to the monthly analysis we conducted, notice that the 200 SMA, stocks over their 200 SMA in the S&P 500, that's the green line on your chart. We color-coded it to the 200 SMA I actually use. 50 SMA is always blue on my screens, right? So this is still well above and sideways in this range. It did not break down. So on this major gap down from Monday, we actually did not see a huge downtick to a new low out of SPXA 200R. You would think if there was a systemic crash taking place and oh my goodness, it's going to be a 2008, it's going to be a 2001, this would be below the 50% mark, and that's not the case. Even the SPX A50R stayed over the 50% mark this week. New highs versus lows at the zero line. I mean, slightly negative, but at the zero line. So breadth traders are probably like, it's still kind of like breadth traders, higher time frame traders. This is really what I would say. Higher time frame monthly traders are looking at this data and saying, yeah, we're just being patient. There's nothing to do on the monthly time frame. This looks fine. Maybe there's a monthly entry. If you're willing to take that risk on the monthly, that's fine, and the breadth might support that. As we move on over to something like the RSP, which is maybe a little bit more insightful for the day-to-day, this is your threat. right? What did we say prior? It was like, hey, bulls should be shouting from the rooftop that this is holding on Friday of 2 weeks ago. Well, as of right now, it can possibly act as resistance. So watching this, it needs resolution. Sometimes on the weekend videos, I wish that we had either stayed below so I could say, hey, any rallies into that should reject, right? But when we've literally closed right at the level, you've got to watch out on Monday. Do we see acceptance over 167 or do we push back down under 166.25? In which case, if this happens, bearish thesis confirmed on the S&P daily. If we take a look over at the QQQE equal weight NASDAQ, getting a little bit of love off of this area of support, which of course is helping the NASDAQ. But the question becomes, do we find an equal weight NASDAQ lower high under 86.20? Continue for the equal low test, and if this breaks, that's where I would say the NASDAQ should at least get to this level down here, right? And that would be sort of your monthly higher low zone. So anyways, still seeing some threats even out of the breadth charts, but the higher time frame ones that we had sort of explored were a bit more helpful. If we look at something like the VIX, huge spike up to 60 on the Monday session, right back down to 2050. What do we know about 2050? It's typically the top end of the range for vol. So if this is going to act as support, and this turns right around, that would coincide beautifully with a lower high, or maybe in the reverse, we should say, rather, that if the S&P rejects here, I would not be shocked to see volatility hold 2050, in which case I don't think that the selling pressure is done in the market. And we know that with the VIX, at least, we have to look behind the curtain at some more supporting evidence. So the VVIX, volatility of the volatility index, is still above its sort of, danger zone, if you will, which is 103. If we're over 103, it's not fine and dandy in the S&P 500. You really got to get under 103, settle things down, and that's where a stronger bottom emerges in the S&P 500. If we take a look at the vol futures, still in a backwardation, well underneath the zero line. Again, even a counter trend move here keeps you in backwardation. What money manager wants to allocate capital right here, right now, when the volatility in the present day is much higher than an unknown future? Why would you not wait until this reinverts right back up to here, or reverts rather, I should say? So that's that. 9 versus 30-day VIX, even if you don't want to use vol futures, at the zero line, at the backwardation mark. The 1-day VIX printed the new high, the highest high it's ever seen since its inception on Monday. As long as this is over 1275, volatility is rocking and rolling, and I don't think we're in the clear yet for this market. So the data points that I'm seeing are more supportive of the bears continuing. To play devil's advocate, once again, I made you that promise, I would want to see this. I would want to see a move over the zero line. I would want to see more acceptance and stability up here. If I'm looking at the 1-day VIX, I want it to be below 1275, and I might entertain stronger bottoms being built in the S&P 500. But as of right now, we're still over these key levels. So this is a threat. This is a threat. This is a threat. I'm not seeing the yellow brick road home quite yet. Let's move back on over to, let's go over to these charts here, and we will get through the core list of companies. Then I've got three trade ideas for you to finish up this week's episode of the weekly watch list. First up, we've got Microsoft. What do we see out of Softy? So here's something to consider as well. Obviously, the core list of companies is a big bulk of the heaviest weight components in the S&P and the NASDAQ. So keep in mind the analysis here and what it might imply for the ETF, right? The Microsoft chart to me would imply that this is trying to find bull flag acceptance over Monday's range high. So that's a good first step. And you might see a continued counter trend move over 408.75 into 416. But at 416, you better bet your bottom dollar I'll be looking for a lower high. The trend here is down. You could make the argument that this is kind of a very weak right-shouldered head and shoulders. A retest of the neckline is nothing more than a bearish Brigade bolt looking for that lower high. If Microsoft is going to prove me wrong, if everything's going to be fine and dandy and oh my God, Matt, you just overreacted to all this stuff, I will wave the white flag if we're over 416 on a Brigade bolt for a more constructive opportunity, some kind of reversal. Until we actually get that, I'm not convinced. Let's take a look at the hourly chart. Again, the counter trend move might be reasonable. Notice that on Friday, breakout over this key level, hold on the pullback. You've got these equal highs. There's an opportunity still to pinch out of Microsoft through this thin structure into 416. So as a trader, I'm willing to trade, it would actually be this. Here's your consolidation, Brigade bolt. I'm willing to trade this point A to point B, but at point B, as I've been very clear in today's episode, I think the watch is for higher time frame, lower highs. Let's jump on over to Apple. Apple has been our diamond in the rough, and we've called this out in numerous pre-market preps, saying that Apple was the one that was still shining here with bar-to-bar higher lows, looking for this gap to close overhead. The gap did start closing on Friday's session, not all the way there yet. So going forward out of Apple, I would be a bit more neutral on Apple, looking for this opportunity. If we can support over 212.75, maybe there's an offering of like continued consolidation and trying once again for 224, where I would really say watch out, look out below. Oh my goodness, bear thesis is alive and well. Matt's going to do it. And that bearish video we put on Saturday, it was all worth it. That's if we fail underneath 212.75. There should be no reason at this point in time that the buyers allow this to fail underneath the breakout point. If this is going to be a successful breakout, this cannot happen. If you spot a lower high here and flush underneath 209.50, 197.75, that's painful for the S&P 500. Next up is NVIDIA, the one stock to rule them all. I would argue that the monthly higher low thesis is in play. So this is a multifaceted approach here. It sort of requires some nuance, all right? So this is not straightforward. This is not simply checkmark bull bear. Monthly higher low thesis could support over the top end of the previous range, and this could mark the low of that monthly move. The monthly would look like this, little consolidation, break, big time Brigade bolt, looking for a higher low over time. That's monthly. We're looking at a daily chart. Try to traverse and bridge the time frames in your head. So for that reason, if that's going to be the start of the monthly higher low, then on the hourly time frame, I need to see a stronger break in the upward direction. 103.50 held pretty decently on Friday's session, but if this is going to turn into a higher low double bottom, you need to break out through the neckline over 107.50. We do have slightly thin structure because notice the market already traded through this level once. This is where it was coming from, but we do have thin structure through it. If we get this move here, I would tend to think that over time, the target's going to be up towards that 115.75, 118, and then we'll reassess because on the daily chart, right, or even the weekly chart at this point, the double top here still has a neckline. We had the daily lower high be set. If this is going to reject for another weekly lower high, I think that that's possible. So there's some nuance. I think that you could go either way here out of NVIDIA. If you're bullish, what you're looking for is this resolution in the upward direction. If you're bearish, then I think that you're waiting for this and then a struggle there for a move back to the downside, and you are not optimistic about the monthly higher low thesis that we were just outlining. So please use some nuance out of NVIDIA. I would not just say that this is as simple as saying, oh, check the bull box, it's back to new all-time highs, or check the bear box and it's back to the lows and then follow through, right? It's got to require some nuance there. So please use those levels appropriately. Next up is Google. I wouldn't call the same monthly higher low thesis exactly just because the consolidation was not as strong as what we had out of NVIDIA. And as a matter of fact, the equal low retest here at 165, in my view, really sets up more of an opportunity for another attempt at a lower high. We've been tracking this ever since Monday, really. Did we just mess up the time frames? We did. Let's go back down to an hourly. These are just inside bars. There's nothing to do out of Google unless there is either a clear look above and fail on 165, in which case the short outcome would look something like this risk reward wise. Short the lower high underneath, look for a target back down to the bottom end of the range. That's a possibility. Or the market will give us something constructive out of the container bar, meaning a higher low above might be bullish into this structure here. A lower high underneath might be constructive under 156.50 to target 151.50. Google is a patience play inside the range. You might get some interaction off the top end. You might get some play here early on in the week. But if you find that like Google's opening drive on Monday puts us in the midpoint, do not diddle in the middle. There's nothing to be done at 160.20. Next up, we've got Amazon. Amazon is actually a possible... I'd like to think of it as an opportunity for the buyers to try to close some of the gap. I would not really be bearish here yet. This is starting to look a bit more like cup and handle. You've got these equal highs. You've got the daily 200 SMA and then thin structure overhead. You'll also notice the incremental higher lows on the bar-to-bar count every single step higher. If you look at the hourly time frame chart, you can kind of see this trend forming. We had a really neutral and consolidating day on Friday. So watching for the Brigade bolt over 168.75 to possibly get through some of the thin structure gap. You do have the bottom end of the overhead supply from the daily. If I do something that looks like this, here's all your overhead supply. That's 172.85. You might want to respect that as a intermediate level before the full gap close up here. To be bearish on Amazon, I would probably need to see a lower high underneath 161.25, simply noting that this grinding trend has been persistent over the last couple of trading days. Next up is the metaverse. What's going on with Zuckerberg's Fantasyland? Daily chart starts. This is really volatile. I would say that Meta has been more volatile than a number of other stocks, and the reason behind it is the gap up on the earnings cycle instead of the gap down where other stocks were already down headed into Monday of last week. So with that understanding, really tough chart to actually participate in. On the daily perspective, you need to see higher lows sustained over 493 coming from this range in the past. Bears, of course, want to be back down below, targeting your equal lows in here. The hourly chart at least offers up a little bit of nuance in terms of how we can participate walking forward. If there's a morning pullback on Monday, you're trying to spot a higher low over this inflection point. I think that one's very straightforward at 506.50. If we can hold it, great. Ultimately, over time, we're trying to navigate to the thin structure earnings gap up high at 528.50. If you're below, this is where I would become a little bit more neutral. You might be able to spot the lower high underneath, and as you can probably start to envision, there becomes a head and shoulders. If you can spot the right shoulder entry, that's fine back down to the neckline, but the bears really want, and again, we just talked about this on the daily, the breakdown under 493 to put that hourly trend reversal in place. There's your sort of lower low breakdown through the neck, right? So that's what I'm seeing out of the metaverse. Tesla's up next. This one looks like a pressure cooker top to me, looking for upside out of Tesla. So this would be helpful for discretionary. One of the things that I want to focus on in the daily is the fact that the gap down went right into this long-standing base out of Tesla. So if this can act as support, and this is almost similar to the monthly higher low thesis we just had on NVIDIA, if we can support off of this key structure, I think that the early stages of this trade might unfold with a breakout over 201. Notice all the inside bars here. It's sort of like a bull flag, if you will. It's a pressure cooker top. You've got all these equal highs, 200 SMA recapture. And then we've got thin structure on the way down to retrace into 215.25. So the trade early on in the week is monitoring for continued consolidation here and then looking for this to the upside, thin structure retracement through that previous range. So 201, higher low Brigade bolt above is really attractive. If we start to drift to the downside, I'm really not encouraged by new money shorts into that daily range we were just exploring at 188.35. A different short setup might have to emerge for that to take place. I just have too many reservations about trying to short into this balance range. It would need to be like acceptance in the balance range and then underneath 170.50, just based on how stubborn this range was from in the past. Next up, JP Morgan. Nice recovery effort, but the threat, of course, is just the neckline of the double top, right? There's your double top. That's 209.50. I think we could get there early on in the week, noting the thin structure overhead, and noting also on the hourly, we talked about this in the pre-market prep, there's your cup and handle, right? Nice break, nice afternoon consolidation that's high and tight. Higher lows over 204.25, looking to Brigade bolt it into 209.50. Any breakouts through the Friday high of day, more nuanced like 5 or 2 minute entries there over that high, also get you to the same target. When we get here, just like the broad market, unfortunately, we have to change our tone. We have to start thinking about lower highs under the neckline of the trend reversal area. If this is going to be a failed cup and handle, I wouldn't short it here underneath the 204.25, but I would start looking for shorts underneath $200.75 for the thin structure retracement into 195.75. Next up is Netflix. Not much to comment on over here. This is one of the most ugly charts I've seen ever since earnings. Grinding all over the place. Can't really, like, these upper wicks were starting to suggest, okay, sellers are trying to step up on the neckline retest. No dice. So I'm really not encouraged by Netflix chart. I would tell you to put that one on the back burner. You can, look back at the levels if you'd like. And then AMD 135, I would say similar to Tesla, has the opportunity for a pressure cooker top. Now, we're not really getting the best indications on Friday, even Thursday. Like, you can see these attempts to get over 135. Here's Wednesday, attempted to get over 135. Even on Tuesday morning, tried to get over. There's not a lot of love happening there, but the fact that we're trying to sustain these higher lows into it, I'm trying to look for the break there, and I suppose to be sort of, giving ourselves a bit more confirmation, it would have to be an hourly higher low. I can't just see like a 5-minute, little dance here at 135. I've got to get an hourly confirmation over that level to really participate in the move into 143.25. The reason I'm not thrilled about a short here, and we've been talking about this in the pre-market prep, is just because of the distance we've already traveled. You could argue that lower prices entice new sellers, and that is true to some degree, but just trade location-wise, which I believe is totally your edge as a retail trader, your location, I can't stomach a new money short dead on the lows of a very severe move. It just doesn't make sense. I would need to see some kind of lower high set, something that looks like this, and then maybe we would re-envision that trade setup at any of those particular levels. So that's my commentary there. 135 is the early week level to watch. Let's move into a couple of these trade ideas. The first one is going to be, if I just scroll to the right place, there we go. We've got PG. The memory did not serve me right, but now it does. The reason I picked PG, and now that we've actually recalled, is simply because this is in the consumer staple space. And as you just saw on the XLP chart, it actually looks constructive with a bull flag. Well, look at this bull flag happening here. And for those of you who are familiar with PG, this is new all-time highs. So multiple inside bars on Thursday and Friday. If we can clear the inside bar highs at 171.25, blue sky territory breakout, and this is something that can continue in the upward direction, even if the market is suggesting more of a risk-off style posture, right? This is a defensive consumer staple based company. So PG 171.25. If we're just consolidating in here, not doing much, not interested until the break actually takes place, and we're monitoring it for momentum. Next up, we have MRNA. There we go. Healthcare sector. And this to me is looking ripe for a possible squeeze. Obviously smashed on earnings, continued to the downside, gap down on Monday. It was not immune, and no pun intended. And if we can clear these equal highs, this is really thin structure off to our left. So this could possibly just be seen as a counter trend oversold bounce. What I would like to see is a green move up and over 85.25. And here's the kicker on this one. As this consolidation has been taking place, look at the taper in volume. I would want to see an increase in relative volume to these breakdown bar or consolidation bars, breakdown volume, and then follow through into some of these moves, right? On the hourly, on the hourly chart, this is just so, obscured because of the access. Look at that. That's crazy. On the hourly chart, right, you could say the same thing as AMD and say, like, there's plenty of range here. You don't need to be the first one in the door. An hourly high or low over 85.25 might do the job to get into 91.40. So that is your upside out of MRNA. Not interested if we're just consolidating down here, right? That's your big caveat to this trade. There's the flag. If we're underneath 85.25, if there is no break and high or low above, there's no trade, because what is this classically seen as on the daily, right? Bear pennant, break the trend line, and it's just off to the races to the downside. So I'm looking for the squeeze. I think that momentum-wise, it would be a fun one to trade, and the setup makes sense. The highs are very precise there. That's MRNA. Next up, we've got DDOG, DataDog. What's going on with the dog here? This is very similar to the lower high theses we've been outlining for a number of the technology stocks so far, but there's, I would argue, even more relative weakness out of a name like DataDog. It did not really participate in a lot of the early year rally to go on and set new highs. It started fading sooner. It's been more neutral and tangled up in this range for a while. So on the daily chart, you've got yourself maybe a Man Ray, or maybe just a head and shoulders, whatever you want to call it. But you've got this neckline retest taking place on earnings off of the low from Monday. This is a pretty decent sized counter trend move in the context of a downtrend, and I think the opportunity is brewing for a possible lower high. So how do we want to participate? Let's go on down to the hourly chart, and we'll get you a nuanced level here for participation. So as long as we're below this orange zone, the orange box, great. Bears are in control. The sell is underneath the Thursday, Friday low. That's at 111.25. You guys know me. Round numbers only up here in the penthouse, and we should even adjust this one on the fly. I didn't see if MRNA and PG had round numbers. I know PG did, but I don't know about MRNA. 111.25, breakdown lower high. First target has to be in here, 106.80. That'll fly for now. And then, really, if you're underneath that, I think the downtrend is going to continue. This is a very lofty target. I'm not saying that this happens over the span of 1 week. Please don't misunderstand. I should caveat this with, please manage your expectations. I'm not saying we go here in the span of 2-3 trading days, but these are the levels that I would mostly watch to the downside. So short entry is here. Lower high. Target this first, monitor for continuation, ultimately with a goal, this is like rainbows and butterflies speculation, down to 100. If it's not going to trigger, if it just stays up here, the trade would be off the table if we get movement over 117.75. Not interested if that breakout takes place, and the daily neckline is not continuing to act as resistance, which it did on Friday, and even here on Thursday, and then the Friday morning session as well, underneath the lower portion of that bound at 115.50. So that is going to do it for today's episode of the weekly watch list, as I'm fighting to hold back all the coughs. I appreciate you guys coming out to the show. We got a one-take wonder today. And if you learned something new, as always, let me know down below in the comments section. If there's anything you think I'm missing, we tried to play devil's advocate. I tried to give you both situations. Personally, I lean a little bit more bearish because of all the supporting evidence that I can see. But if I'm missing something, please tell me in the comments down below. Tell me where I'm wrong. I'd love to consider your viewpoints, and maybe that makes me change my tone sooner than I otherwise would. But based on today's exploration, you know where my head's at. With that said, I wish you a green trading week, and I will see you in the next one.